Time is ticking. It is almost the 1st of July, which means this financial year is almost over. The financial year is a hard date when it comes to tax. There are certain things that you should be doing before the end of the financial year to ensure you're putting yourself in the best position to maximize your tax return. Here are my top 5 tips for individual taxpayers. The first one is check your superannuation contributions. If you're considering making an additional super contribution, you want to first check, have you actually used all of your concessional contribution cap for this year? You also want to look into your prior year unused concessional contribution caps that you may be able to use. We do have caps on how much concessional contributions you can make in one financial year. So for this current financial year, 23-24 is 27,500. So if your employer has already contributed to your fund, that counts towards that cap. Now you can use the unused cap from the previous 5 years. Go to your MyGov account and you'll be able to go into the unused carry forward section and you can see what's available. If you are going to make a contribution to your super fund and you want to claim it as a tax deduction, make sure you get onto this ASAP, check with your fund what their cutoff date is, and then make sure you fill out the correct paperwork, a notice of intent to claim form. And as always in this space, go and seek advice if you want to find out if a super contribution is right for you. The second one is getting in those last minute tax deductions. If you want a tax deduction to count in this financial year, you must do it before the end of 30th of June. So go out there and spend the money on your work-related expenses. But let's strip it back to the basics and we need to make sure it is actually claimable for tax. There's no point rushing out a tax deduction that's not claimable. So we still need to tick off the golden rules of a tax deduction. It needs to be used for work-related purposes. You must have a record to prove that the expense actually exists. And of course, if it has a private portion, you need to make sure you're apportioning for that. Make sure you're ticking all of those boxes if you're rushing out to get the deductions before the end of 30th of June. Now, just be aware that certain deductions over $300, such as equipment, maybe you've gone out and bought a new laptop for work, if they are over $300, they'll need to be depreciated. And the depreciation start date is the date of purchase. So if you do rush out and buy something before the end of June, if you only buy it in June, you're going to have a minimal claim for this current financial year. Now, that's not always a bad thing. It means your claim will roll forward to next year. You will get to claim it over the period of the asset life, but just be aware it might not dramatically increase your deductions for this current financial year. The third one is looking into your capital gains items. The first thing I always tell people is go ahead and check, have you sold any asset throughout the year that could be subject to capital gains? So have you sold any investment properties, any shares, any crypto? And that includes crypto to crypto. Make sure you're aware of what your current position is. Then you can look at what's the current tax position. Am I going to be owing a lot of tax because I made a couple $100,000 off a property? Then you can start to look at what other capital assets am I currently holding? Do I have some other capital assets that are in a loss position that I've been considering selling that if I sold now, I can offset that capital loss against a capital gain? You want to think these things through because the timing is really important. If you have a capital gain in this year and you've got some assets that you sell for a loss, if you sell them in this year, it's easy. We can take capital gain less capital loss to get our total capital gains that will be taxed on. However, if we sell that loss in next year, we still have our capital gain from this year, but now we've got a loss next year, and if we have no other capital gains next year, we can't offset against our regular income. So the timing is really important. If you're unsure, go and seek the advice of your tax agent. And that leads perfectly into something I do want to plug, and it's my newsletter. I put out a newsletter every single week throughout the entire year, but obviously people are going to really love it during tax time because it has free tax tips. I'm alerting to you to things like what I'm talking about in this video, so you've got the time to prep and you've got the time to maximize your tax return. Now let's get back into the video, and it's number 4, and it's find your receipts. Go out there and find your receipts now, not when you're scrambling around trying to do your tax return. The earlier you can get onto your record keeping, the way more prepared you'll be, and you'll actually put yourself in the best position to maximize your tax return. The biggest area people go wrong with their taxes is they forget to claim legitimate items. If you've actually spent something on a work-related expense and you don't claim it, you are costing yourself money. Just put a system in place so you can store the receipts throughout the year. If you're going on a work trip and you go and spend money on a taxi, for instance, while you're away for work, store that receipt somewhere. Take a photo, put it in a Google Drive, use the ATO app. Just find a system that works for you. And obviously, where possible, do it digitally so you don't have to worry about losing receipts, the receipts fading, etc. Always keep the records, even if you're unsure if they're claimed. If it's a 50-50 error and you're really not sure and you've done some research and you're not sure, just keep the record, because you can always ask your tax agent at the end of the year and go, can I claim this item? Because if you can't claim it, well, it doesn't matter. You get rid of the receipt and you don't worry about keeping it going forward. But if you can claim it, you've got the record there now to substantiate your claim. And there we go. We're maximising our return by maximising our claimable deductions. And the fifth one is if you're using the logbook method for your car, go ahead and check when you last did your logbook. Your logbook needs to run for a period of 12 continuous weeks, and it needs to be a true record of your normal usage of that vehicle. But this only lasts you for 5 years per vehicle. So make sure you go and check when did you last do a logbook, and if it is past that 5 years, you need to do an updated one. Or has your usage of that vehicle changed? Maybe you're using it a lot more for work purposes now, and it will be worth your while doing an updated logbook. Now, do remember, if you are using the logbook method, you need to be keeping records of all of your motor vehicle expenses, because you'll be claiming a percentage based on the business/work usage of that vehicle. Now, if you're using the cents per kilometre method, you don't need a formal logbook, but you do need to have a record of how you've come up with the kilometres you're claiming under that method. Now, there were some big changes that affected individuals that were released during the budget this year, including tax cuts for all Australian taxpayers. In this upcoming video, I go through the key changes that were announced in the budget that affect individual taxpayers. I hope you've enjoyed this video, and I'd love to see you over there.